This computer. Okay. So good morning, everybody, and nice to have you all. As usual, we try to bring value to you, and sometimes there are programs out there that we don't know about, and those are very useful programs for our buyers. And I always want to share them with you. I want to thank David for bringing it to our attention through one of his transactions. And Matt is the lender. Matt Callahan is the lender who did this loan. So we decided to invite him over and let him talk about this program, because I'm sure you will be able to use that, especially in this market when everything is so high in prices. And not everybody has this $200,000, $300,000 cash sitting in their savings account, especially our first-time home buyers. And I think we should take advantage of programs like this that Matt is going to talk about. So with no further ado, I will let him take over, and welcome to our morning Zoom meeting.
Thank you so much for the opportunity to meet with you all. I think it's great that you do this kind of training for your team members, and especially to be open to hearing about first-time homebuyer programs. Unfortunately, there can be a little bit of a prejudice against working with these different types of programs that assist first-time buyers. They're viewed as being more complex, taking longer to close, and I totally understand that. So it's great that you're open to that. I felt very fortunate to get to meet David a few months ago, David Villanueva, who I didn't know him at all, but it turns out he's an amazing realtor. And he's done a great job for our mutual client, Kaylin. He got her in contract on a townhome in Sylmar. I think it's $505,000. She's a single woman, just pretty young. I think she's under 30. And she had some savings, not a lot. I think her total contribution to this transaction is going to be pretty far south of $30,000, around $26,000 total, maybe. And we were able to arrange an additional $60,000 of down payment help for her from the city of Los Angeles. So those funds are being used to boost her buying power, to make her help her qualify for this price point, and reduce the amount of money that she needs to contribute, and also end up with a payment that's pretty affordable to her. And so I'm really excited to be able to talk with you about it. I'm going to share my screen here, if this works, hopefully. And I did put together some handouts for you all, and if you haven't gotten them yet, you will. And so everything that I'm showing you, you will have access to after the meeting. But I always think it's best to start at the beginning and thinking about, why is it that we do what we do? What are the benefits and barriers to home ownership? Why should people think about buying a home? And what I want to say about that is, because we work in the industry that we do, and we love it and we care about it, we may not be aware that there are forces in our country and in the state that want to limit home ownership opportunities to the elites, to the most wealthy people in our country, and they want the rest of the population to live in low-income rental housing projects, mostly managed by government agencies. So there are risks to what we do out there. So it's important to have a good grounding in why home ownership is important, and be able to articulate that when you're question. It's kind of like having your elevator pitch, to be able to say, well, why is homeownership important, and have some good reasons for that. So I'm not going to go over all of these reasons, but we come up with 10 important reasons why homeownership really matters to individuals, families, and our society. So I definitely encourage you to review these and kind of have them ready to go, and to respond to any objections on why we should be focusing on expanding homeownership opportunities, especially for low and moderate income households. But the real thing I want you to spend a few moments on is thinking about the barriers to home ownership. Why is it difficult for low and moderate income first-time home buyers to buy a home? And we see five key reasons. The first is savings. There's most working individuals and families find it difficult to save up enough money for a down payment and closing costs. They're kind of living paycheck to paycheck, and it's just difficult to save up for a traditional down payment and to cover closing costs. The next barrier that we see is affordability. That's the gap between buying power and home prices. And of course, in Los Angeles market, that's a huge challenge with home prices where they've gone over the last couple of years. It's really, really super challenging for low and moderate income first-time home buyers. The third barrier is access, and don't underestimate this barrier. A lot of people are confused about the home buying process. They don't know where to start. They don't know the job of a realtor. How do they find a loan officer? What is an appraisal, home inspection, title insurance, PMI, interest rates, rebates? All these things are super confusing to people. And even if they're, our sort of sophisticated millennial home buyers, don't assume that they know what they're doing, and they will often not move forward just because of ignorance. And so access to the home buying process can be a significant barrier. The fourth is credit. The vast majority of people finance their home purchase, and so you have to have a credit reputation that supports being able to qualify for the home loan that you want. And it's not surprising. Life happens. People have divorces, illnesses, loss of job, maybe just financial mismanagement, and their credit has suffered because of that. And the fifth one is what I call the dream home syndrome. That is, people only want what they can't afford. And I'm sure you see a lot in your business working with buyers that they are qualified, they actually can't purchase, but they're not flexible enough, and they don't see their first home as being a stepping stone to future opportunities. So all five of these can be barriers to home ownership. And I think it's important when you're meeting with a client to be thinking in terms of, what is my client facing in terms of what is their barrier or barriers to home ownership? Because then you can start thinking in terms of resources and strategies to overcome those barriers. So fortunately, in the Los Angeles area, we have some great programs available for first-time home buyers. And so these are government-sponsored programs that are available for first-time home buyers, which is generally defined as someone who hasn't owned a home in the last 3 years. So it doesn't mean they haven't purchased a home in the last 3 years, but actually been on title to a home in the last 3 years. And so the programs that are available deal with those barriers that we just talked about. They deal with cash to close or savings. They deal with affordability. They deal with credit. They deal with the access barrier. And it's your job to help overcome the dream home barrier. And actually, we have some tools for that I can mention in a few minutes. But there are some great programs. A lot of times old people like me, we say, remember the good old days, right? And I actually think right now we're living in the good old days of home ownership. There's so many great programs and resources available to help people who thought they never could be able to purchase a home. So that's particularly true in Los Angeles. We have two great programs that I'm going to drill down on here in a minute that are available. One of them is the program that we're currently using for David's client. And the first one is offered by the City of Los Angeles. Now, the City of Los Angeles is really, really large. And I'm not sure if you can see this here, but the City of Los Angeles is really, really large. This is one of the handouts that you're going to get. So the City of Los Angeles includes the entire San Fernando Valley. So when people say they live in Van Nuys or Chatsworth or Woodland Hills or Sylmar, those are not cities. Those are neighborhoods in the City of Los Angeles. So the City of Los Angeles includes the entire San Fernando Valley, and then going south, west, and east, it includes Hollywood, North Hollywood, coming into LA proper, all those communities below Dodger Stadium, Eagle Rock, Highland Park, El Sereno, Lincoln Heights, Boyle Heights, City Terrace, downtown Los Angeles, West Los Angeles, mid-city areas, South Central Los Angeles, Watts, Southwest LA, West Los Angeles going out towards the airport. It even includes San Pedro and Wilmington by the port. So as you can see, the city of Los Angeles is a huge area. And right now, the city of Los Angeles is offering $90,000 of down payment help for first-time homebuyers. And I actually have this guide here that you'll have access to. It's a guide that I've put together for real estate agents on how to use this program. And it even has a sample RPA and how you might want to fill it out. So basically the way it works, it's called layered financing. So let me go over to that slide if I can find it here. Here we go. Sorry about that. Excuse me. Let's see. Here we go. Layered financing. So the way it works is the buyer is going to contribute some minimum contribution that they have to bring to the table. They have to be able to bring to the table 1% of the purchase price from their own blood, sweat, and tears money. This is the money they've personally saved up. It can't be gift funds. It can't be magic money that just shows up some way. It has to be money that we can verify that they've saved up over the last 6 months at least. It can be a shorter period of time, but it has to be their personal investment of money. So I tell most people, if you can put together around $4,000 to $5,000 of your own personal savings, you're ready to go. So you can see how that one provision of this program addresses the affordability barrier and the savings barrier, because now they only have to come, instead of having to come in with $100,000 or $200,000, they can really get started with about $5,000 if we can make it work. I have many clients who purchase a home with, just, $4,000 to $6,000, $7,000 using this program. The next layer on the financing is their first mortgage. So this is a traditional 30-year fixed rate home loan. And the vast majority of times it's conventional conforming. That's a Fannie Mae, Freddie Mac loan. So it's typically not FHA. I get that question a lot. Oh, this is an FHA loan. No. In the vast majority of times, the conventional financing, the first mortgage financing the buyer is getting is a conventional loan. So that really helps us on condo and townhome purchases because we don't have to worry if it's an FHA approved condo project. We can do a spot approval with, as a lender on a conventional loan. So the size of that loan is going to be based on their income and debts. The more income they have, the more buying power they're going to have, but then their debts like student loans, credit cards, car loans, all reduce their buying power. So the first thing we do is we figure out how big that loan can be. The next layer then is going to be this down payment assistance loan. So this is the help we get from the city of Los Angeles. And it is a true loan. It's recorded as a lien on the property and subordinate to the first loan. So it's a secondary financing. We call it a deferred repayment loan because there's no monthly payment due for 30 years. It just sits there silent or soft for 30 years, no repayment requirement during that entire term. Now it becomes due at the end of 30 years, or more typically when they sell the house or transfer title to the home. Most first-time home buyers sell their home and their first home in 7 to 10 years, statistically. So, when they sell their home, at that point, the city's loan gets repaid. Now it's a zero interest loan, so it's not accruing interest. It's not negatively amortizing. It's just sitting there silent for whatever term until it's paid. There is something called an equity share or shared appreciation feature to the loan. So basically what that means is when you sell the house, when your client sells the house in the future, and if they've made a profit on the sale versus what they've originally purchased it for. So for example, David's client, she's buying it, let's say for $500,000 right now. And let's say she lives there for 5 years and calls David up 5 years, because I'm sure he'll still be working in real estate then. She'll call him and say, hey, David, it's time for me to sell. And he'll run the comps and say, hey, I think we can sell it for $600,000. You bought it for 5, we're going to sell it for 6. So there's a $100,000 gain. That's the appreciated equity. So she's going to repay the $60,000. In her case, she qualified for $60,000 of down payment help. And she's going to repay about 13% of the appreciated equity. So of that $100,000 gain, she'll pay back $13,000 to the city, and $87,000 will stay in her pocket, along with all the equity that built up from paying down her first loan during that time, plus her initial contribution. So it's really a great deal for the home buyer, and it helps the city recycle that money to help new home buyers in the future. I've been doing this program for 20 years, and we've helped hundreds of families with it, and that money just gets recycled. And that's a key point about the City of LA program. In the 20 years that I've been working this program, we haven't run out of money once, except in the early days of COVID, and they didn't run out of money. They just didn't have staff that were coming to City Hall to run the program, so they shut it down for a month. But other than that, the program has been operational that entire 20-year period that I've been working with. So you really don't need to worry about this program running out of funds. Now, the great thing, the final layer here is closing cost assistance, because we can use this money, this down payment assistance money for the city, not only as applied to the purchase price, but we can also use it for closing costs. So you don't have to worry about negotiating a seller credit or giving up an agent credit or anything like that. We can use this money for down payment and closing costs. We can finance up to 105% of the purchase price using this program. The credit score requirement on this program is 660. They have to have a middle credit score of 660 or better. And they have to be a first-time home buyer, and they have to fall within the income limits for the program. And let me show you those income limits right now. So it's based on household size. The more people you have in your household, the more income you can have. So in Kaylin's, David's client, she fell within the category of moderate 120 because she's making about $90,000 a year. So under the moderate 120 program, as a one-person household, she's receiving $60,000 of down payment. Now, if she had been a little bit lower income, let's say she made less than $66,250 as a one-person household, she could get $90,000 of down payment help. And then if she was higher income, if she made up to $124,000, she could get $35,000 of down payment help. So what's unique about the City of LA program is they have assistance not only for low-income households, which would be that 80% area median income. That's what AMI stands for, area median income. That would be for low-income households. It's not unusual for most communities to have programs for low income, but very few communities have programs for moderate income. And so we're very fortunate in the City of LA to have this program available. The other thing I would say, and as you can see, as the household size gets larger, someone could, so if you still qualify with higher income in the household. So if you had a couple who made $124,000 a year and they had 6 kids, which is a little bit unusual today, but it still happens. If they had 6 kids, they could qualify for $90,000 of assistance. So I'll stop there for a minute and just ask if there's any questions.
I do have okay, you can go.
Sorry, I was just going to ask, where are you getting those numbers from on the left? Like the percentage of down payment assistance that they're getting?
Oh, I just have it memorized. I'm sorry. So
okay.
For the low income bracket, it's up to, if your income is up to the 80% area median income, you can get 90. For the moderate 120, it's 60,000. And for the moderate 150, it's 35,000.
Got it.
Angela, go ahead.
For the buyer contribution, is there a cap for the buyer to qualify? Like, for example, if they had $10,000 in buyer contribution, will that be a problem for this program?
No, the minimum they have to contribute is 1%, but they can have as much money as they want to contribute. That 1% has to come from their personal funds, but they could have additional money either that they've personally saved, or they could have family gift funds, for example. So that way we could really get even more buying power with this program, because we can combine the city's assistance along with their increased contribution. So there's no max on the contribution, there's just a minimum.
Okay, thank you.
Okay, Mark,
Question.
I have a question. As far as the incomes are concerned, is this the gross income? Or like for somebody, is it gross or net income?
It's
Person?
gross income. And I would just say that this whole issue of income eligibility is one of the trickiest things about the program. And what I normally tell people is you're not qualified to disqualify yourself. And what I mean by that is that there's often many reasons why somebody may look at this chart and say, oh, I don't qualify, I'm over the income limit. But then when we look closer at their situation, they actually do qualify. So let me give you a simple example. Let's say it's a husband and wife and their income is $80,000 a year. So if you look at this chart, that would put them over the income limit for a two-person household, right? But then in the course of conversation, I find out they have an adult child away at college who really keeps their home as their principal residence. They claim him as dependent on their tax returns still. He's not living there most of the year, but because he's still a dependent and because he still claims it as his personal residence, we can count him as a whole household member. And so now it's a three-person household, and now they qualify. So, use this chart as a guide, but don't do, until you've done a few deals with me, you're not qualified to disqualify anybody that you're meeting. Let me do that.
Yeah.
Because we can look at a variety of factors and oftentimes figure out in a legitimate way. I'm not here talking about gaming the system or doing something inappropriate, but legitimately confirm that someone qualifies for this program.
Okay, it was only because we have some like 1099 people, even people who are in real estate who want to buy, and they may be making $150,000 and one person household as a gross income, but after they deduct all their expenses, they go down to 120. Will that be somebody who is eligible, or from get-go, we know it's not going to work?
So that could work. So when you're self-employed or a business owner or a 1099 worker, you're typically filing a Schedule C on your tax returns. So on that Schedule C, you're reporting your gross business income. That's all the revenue into your business. And then you report expenses that you incurred in running that business. And then you have your net income. And that net income is the taxable income that you pay taxes on. And so for underwriting purposes, we use that net income. And also for eligibility purposes, we use the net income. So that's the way it works. As a self-employed 1099 or business owner, we use the net income. Now, the problem I face as a lender is not the scenario that you proposed, Arlene, where someone gets 150,000 gross and then has $10,000 of expenses. It's the opposite. They have $150,000 gross and they report $149,000 of expenses and they only have $1,000 of net taxable income. That's the vast majority of cases that we see where people have excluded almost all of their business income with expenses so that their net taxable income is very, very low, almost so low that even when we include all these assistance programs, they're not going to have any realistic buying power. Because keep in mind, going back to this layered financing, they still need to qualify for a decent size first mortgage so that when we add the city assistance, they'll have a realistic buying power. So if someone's reporting, $5,000, $10,000 of net business income a year, then the $90,000 they might get from the city is not going to help, because $5,000 to $10,000 of net business income a year doesn't qualify you for any size of first mortgage. Does that make sense?
Yes, it does. Okay.
Yeah.
You can.
So I actually have a guide that I put together for self-employed people. You can go to my website, which is homecenterla.com, homecenterla.com, and download all of these resources. But I have a guide there for the self-employed home buyer and how they qualify. And, it's unfortunately the options for the self-employed home buyer are basically bite the bullet for 2 years and report enough net business income to qualify, or switch to a non-qualified mortgage. And when you go use a non-qualified mortgage, you cannot take advantage of these first-time homebuyer programs.
And everybody on the line, that's why we always say home buying is a process. It's not an event. So if you are thinking that you want to buy a house, you need to plan ahead. That's the kind of conversations you should have with your buyers, that maybe it needs 1 year, 2 years planning, depending on a lot of things in their scenario. So keep that in mind when you're talking to the buyers, okay? That's a very important point of conversation with them.
And I heard this expression, maybe from another real estate broker, so I'm stealing it from her, but she told me in her business, she teaches her agents that the fortunes are in the follow-up. The fortunes are in the follow-up. The way you're going to make money in real estate is to follow up. So you may have a client now who is self-employed but has been underreporting significant income, and so you get a guide like the one I have, or get other information for them and help them prepare for a year from now or 2 years from now, so they can purchase, because the fortunes are in the follow-up. If you meet 10 clients in a day, the chances are 6 or 7 of them are not ready, maybe even more, but they could be ready in a year from now or 2 years from now. So that's a really good point. I really like what you said.
And one more thing
Hey,
that
Matt.
you can just say, you said 13% of equity. Is 13% a formula that we need to know, or is it?
Yeah, let me be more precise. And I'm going to use David's client as an example. David's client is getting $60,000 of down payment help from the city. So I'm using my little calculator here. And so she's getting $60,000 of down payment help. The purchase price is $505,000. And so when I divide 60,000 by 505, that turns out that it's 12%. The city's initial assistance in this case, in David's case, was 12% of the purchase price. So the equity share formula is calculated based on the amount of assistance the city initially provided relative to the entire purchase price of the home. So in David's client's example, it'd be 12%.
Thank you.
I have a question. This program works for house or only condo and townhouse?
There'll be detached single family homes, townhomes, condominiums. It has to be a fee simple transaction, meaning ownership of the land is included. It cannot be manufactured homes on leased land. It cannot be own your own or co-ops, tenants in common, those kinds of things. Those don't work. So it has to be a traditional fee simple transaction, single family home, townhome, or condo, or a PUD. That'd be fine too.
And does it have a limit?
Any what?
Any limit? Does it have a limit, like?
The moderate income program, so the two programs here, the moderate 120 and the moderate 150, have no purchase price limit. The low income program has a purchase price limit. I think it's right now like 720,000. Realistically, if you're low income, even with all of the assistance you're going to be below 720,000 in the purchase price, unless you have some amazing, huge additional down payment that you're bringing to the table.
Thank you.
Matt, I have a quick question. Let's say that a first-time home buyer uses this program to purchase a home, and they decide to 2 or 3 years down the road purchase a second home. How would that affect them purchasing a second home is my first question. And then secondly, how would it look if someone were to refinance under this situation?
Let me take the refinance question first. So the city does allow for refinancings. They allow for what we call rate and term refinancings. So they'll resubordinate their junior loan. They'll keep it in second position to allow for the refinance of the first loan. So that's actually been a great business for me for this past year. I had clients that I closed, a few years ago, and they got rates in the 4s, which was a great rate at that time. But we're refinancing them all now down into the 3s or below, like most of them are below 3. So yes, the city will allow for refinances if it's a rate and term. If it's a cash out refinance, they will require that their loan be paid first before any cash out money is distributed to the home buyer. So in most cases, people don't want to pay off the city because it's a silent 0 interest loan. And so we don't do too many cash out refinances.
Sure.
On your other question, one of the requirements of the loan agreement that the borrower signs with the city is that the property remain owner occupied. It's intended for homeowners, not for investors. So if they left the property and turned it into a rental, the city could enforce its provisions under that agreement. And pretty much the worst thing they could do to the person is tell them to move back in. Technically, they could probably move with a foreclosure, but it would be a judicial foreclosure where they'd actually have to go to court and sue the person under the terms of the loan agreement. I had a client who bought a home like 18 years ago, and then she never sold it, got married, her and her husband purchased another home, and she was renting out the home that she had gotten with city assistance. After about 10 years, the city caught up with her and wrote her a mean letter and said she had to move back in. So I'll just answer it that way.
All right, fair enough. Thank you.
No one's doing bed checks at the city to see who's living there. Having said that, the vast majority of people, use this first home purchase to sell, take their profit, and move on to their next purchase.
Sure.
I did want to mention that aside from the City of Los Angeles program, there's also a County of Los Angeles program, and you'll get the guide for that one as well. So the County of Los Angeles is the bigger governmental agency. Then within the county, you have the City of Los Angeles, which is the largest city. Then you have about 60 other smaller cities, everything from Long Beach to, Compton, Carson, just there's about 60 other smaller cities going all the way out to Pomona. And the county program covers those cities, about 49 of those smaller cities. The county program is only for low-income households, and it provides $85,000 of down payment help instead of $90,000. And it's also a great program. We use it to help a lot of people. One of the cool things is it does cover the unincorporated areas of the county. Those are parts of the county where there is no city. So if you have clients that are interested in the Antelope Valley area, so for example, Quartz Hill is an unincorporated area, and there's a lot of great home prices out there. It's a great neighborhood, and you could use the county program out there, and the price points are a lot more affordable in those areas. So you'll get the guide to that program as well that has all of the areas that are served by that program, and it operates very similarly to the LA City program. I would say that the LA City program is really well run. I know a lot of people, when they think about government agencies, they think about the last time they had to go to the DMV, and so they cringe. But I'll tell you, the LA City program is run really, really well. It's efficient. The staff are on it. They care about it. They like their jobs, and they do a really good job. So in terms of escrow closing periods, I advise agents to assume a 45-day closing. Sometimes, I've closed a few at 30 and even a couple, some less than 30, but that's rare. Sometimes we kind of play a game with the listing agent and they insist on a 30-day term in the purchase contract, and then we get to day 25 and we just say we need an extension. So 45 days is probably the most realistic time frame. So that's it for my presentation. I thank you very much for allowing me to meet with you, and I will, you'll get these documents, and I put my contact information in the chat, and I definitely look forward to having an opportunity to work with you and your clients.
Hey, Matt, I have a question. So what is the best process for, like, if we do have a client and we would like to, introduce them to you and start that conversation, what is the best process to do that? Is it a text? Is it an email? Is it?
Yeah. In the chat, I put all my contact information. I have this app that I use that works really, really well. It's called meetwithmatt.net. It's kind of corny, but meetwithmatt.net. Matt's with 2 T's, not like a doormat. Meetwithmatt.net. And they can, and you could set it up for them, or the client can go themselves, choose a time that works for them, a day and a time, and it automatically populates my calendar, it populates their calendar. And we can do it on a virtual meeting like this, or we can do it a phone call, or I do have an office in DTLA that I can meet. If there's diehard people that want an in-person meeting, I can do that well. The other thing, if it's helpful to your clients, I'm pretty fluent in Spanish.
Wow,
And
that's
so
amazing.
I help a lot of Spanish-speaking clients.
That's amazing. Sorry, and one more question. Do you prefer a phone call from us, an email from us, or a text?
Text is really good, but I'm whatever is great.
Okay,
I'm 24/7 with text. Usually I stop taking phone calls after about 7 in the evening, but 24/7 with text.
Okay. I'm Matthew, by the way. I will be reaching out. I have a client.
Okay, great, Matthew. Good to look forward to hearing from you.
Thanks.
I
Okay, well,
put the
David,
PDF in the chat too, by the way, so you guys
Pardon
can go over it. The PDFs are in the chat.
okay.
I saw that. Thank you so much, David.
All right, well, I'll step out of your meeting, and thank you very much for the opportunity. I look forward to working with you, your team in the future.
Thank you so much
Thank
for
you,
your
Matt.
time. We know that your time is valuable and we truly appreciate it. We hope this will be the beginning of many transactions, because people in Los Angeles do need to be aware of this type of programs. And
Yeah.
we always want to work with an expert in the field. So
Thank you very much.
we'll be in touch. I'm going to stop recording now, and we'll talk